Welcome to the Investing Show, where we discuss the news that matters to investors and get ideas to help you make more of your money. I'm Simon Lambert of This Is Money, and joining me in the studio today, yes, in the studio, not over Zoom, I have Richard Hunter of Interactive Investor. Richard,
hi Simon.
Welcome back to the studio.
Thank you very much.
We are at a stage now where everyone's hoping that we're well on the road to recovery. We talked about this on the last Investing Show when we had Tom Beckett join us, the sort of the recovery, the vaccine rally play and things like that. Now, one of the key things that people look to for the state of the economy, be it the global economy or the UK economy, is the financial system and the banks. And we've just had the UK's major banks report last week, and the numbers were quite good, weren't they? Everything seemed to be looking up for them and better than expected, would you say?
Yeah, I think so. What hadn't happened at the full year numbers 3 months ago was that there'd been a couple of US banks which had been releasing provisions, and we'll get to that in a second. And there was expected to be a read across to the UK banks, which there wasn't. Whereas for the first quarter numbers we've just had, that was very much a feature. And just by way of a memory jolt, what happened last year, of course, is at the height of the pandemic, UK banks were putting aside tens of billions of pounds towards what they regarded would be an increasing number of bad debts, impairments, etc. So they were making those billions of pounds worth of provisions. As things currently stand, they're deciding that the situation isn't quite so dire, and so they're releasing some of those provisions back on the basis they may not be needed. And of course that immediately filters into the trading performance. So whilst the overall Q1 numbers were pretty strong across the board, they were very much flattered, with the exception of Barclays, who didn't release any money back. They just made a smaller provision. But the other banks all made large releases back into their own system, if you like, which very much flattered the numbers.
And just before we go into the individual banks and how they've fared, what that might look like for their share prices as well. The reason for doing that and holding all that money back was a prudence, wasn't it? And they were also told they couldn't pay out any dividends too, which helped in terms of stockpiling that money. But people were very worried about the banks as this hit a year ago. The financial crisis is relatively fresh in the memory, and there was very much a, uh-oh, what's this going to do to the banking system? Are we going to see a rerun of a financial crisis? But the key difference was that the banks went into the COVID crisis looking substantially more financially healthy than how they went into the financial crisis, where they would have told you that everything was absolutely great, and then once the rug was pulled back, it turned out that it wasn't.
No, you're absolutely spot on. The so-called CET1 ratio, which is the figure that you're referring to, easier known as the capital cushion, is monies that they have put aside. Now, each of the banks has reported a very strong capital cushion, well in excess of the regulatory amount they put to one side, and for most of them in excess of their own immediate targets. So what that is telling you is that, again, on the whole, the banks are currently awash with capital. They're certainly much better capitalised, as you say, going into the crisis this time round than they were 12, 13 years ago. And it also augurs well for what they might want to do in terms of deploying that capital, whether that is, for example, dividends, as far as they're allowed. There's still a regulatory cap there, whether they're going to go in for share buybacks, or in the case of NatWest, for example, even buying back a further slither of the government slate, which they managed to do back in March.
And does it also indicate that they might be quite ambitious in their plans going forward in terms of business plans, saying, right, okay, let's back this recovery idea?
One of the things that's certainly becoming, it's well reported on anyway, but certainly in terms of the more UK-focused banks, they're looking to transform into a digital operation, and you can see why. If you've got an increasing number of people doing their banking either via the laptop or via the mobile, etc., you've got less and less of requirement for physical bank branches. And of course, not only that, if you then expand that digital service, you can do it at a much lower cost, because it's basically rolling out software to a greater number of people. So that's clearly the way the banks are going. Obviously, we've all read about there are certain pockets of the country where that may not work so well because the nearest branch isn't, for 10 miles or so. So there have been some talks about perhaps sharing branches with post offices, etc. But you can certainly see the direction of travel when it comes to physical bank branches.
So looking at the individual banks themselves, picking out Lloyds first of all, it's the one that's considered a bellwether for the UK economy, UK consumer. How's Lloyds been faring?
Yeah, it's been a conservatively run bank now for the last few years. Obviously, the CEO is now stepping to one side. There was a lot of similarity actually between one of the themes that was coming through, but at Lloyds in particular. Lloyds has got a massive presence in the mortgage market. Now, obviously, as we've been seeing from the house building shares, there's a lot of tailwinds going on at the moment. You've got historically low interest rates, various government help to buy schemes, stamp duty holiday, etc. Mortgages are freely available, and there's still a housing shortage. So what the UK banks have tended to see is a big pickup in mortgages, which is good business for them, obviously Lloyds in particular. But alongside that, and again, as we knew, and this is one of the reasons the banks are the bellwethers, there's been a clear decrease in the use of overdrafts, and there's been a clear decline in terms of credit cards because people have been paying down their credit cards. And of course, overdrafts and credit cards are two good income lines for the banks. But it's notable, particularly during the last few months, we know that we're in some ways enforced into becoming a nation of savers. That is clearly now being borne out in terms of what people are actually doing with their money, and not necessarily in favour of the banks, because as I say, the credit card and overdraft lines are pretty much evaporated for the moment.
And they've got the challenge coming from the buy now, pay later firms, the Klarnas of this world, haven't they? You know, with things like credit card spending, etc., which obviously could bounce back if the economy bounces back. But who knows? Maybe the great British public have found a newfound love for saving.
And that adds another pressure, of course, because running alongside that, you've got historically low interest rates, as we say. Banks traditionally would make their money between the rate at which they borrow themselves and then they lend out. And of course, there is very little for them to play with in terms of what is either net interest income or, more importantly, their net interest margin. And of course, low interest rates, it seems likely that they're here to stay. So what with credit cards and overdrafts currently being out of favour, a couple of them are looking towards more services which are perhaps fee income based rather than in terms of interest, where clearly there's little room for manoeuvre.
And just before we move on from Lloyds, we have to talk about the share price. It's, I mean, the soap opera that is the Lloyds share price. If we ignore the bit where it fell off a cliff in the financial crisis and just concentrate on life since then, there's always been this question of when's it going to kick on to 100p, to that £1 level.
Yeah.
And we've had a number of false dawns there. I was looking at the chart earlier. We got up to the heady heights of 80-something p in 2015, and then obviously it was hampered by the Brexit vote, the Brexit negotiations, all the things that have gone on since then. We're now at about 47p, I think, at the time of doing this show. Do we think now, the next couple of years, it might kick on and move up a level, or is it going to continue to be held back?
Well, there's certainly been some sharp spikes in the share prices of the banks since the lows of the pandemic in March 2020. But as you say, if you go any further back than that, then you'll see over a period of time they've certainly been underperforming. Partly because of the reasons that you mentioned around Brexit and uncertainty. Also, of course, the fact that the UK has been very much out of favour as an investment destination for some considerable time. Now, there are some signs of that beginning to reverse as we speak. The FTSE 100 in the year to date, it's up about 8%, which is going some. And of course, a lot of that is driven by the cyclical kind of value stocks that you've got within the FTSE, and that the banks, the oils, the miners. So that bodes well for the banks over the next year or so, particularly if the momentum can be carried on from the first quarter. As I say, you may, on top of that, have some increased international interest coming through. Again, that will be a positive for the banks. The question then is whether the regulator takes off the caps in terms of the dividends that can be paid out. Because one thing with the Lloyds share price is that although it's been disappointing, at least to some extent investors have been paid to wait. It's been a very high dividend yielder historically. So I think the stage that the banks need to get to is really to convince the market that they're not just a utility but they can actually go in a slightly different direction. But there's no question, if things carry on as we've seen over the last 3 months or so, that a few of the shackles have definitely been released.
Okay, well, taking us on to another bank that definitely has had more than a few shackles attached to it and has tried to reinvent itself, the NatWest, formerly known as RBS. Where do we stand with NatWest at the moment? How's that been doing?
Very similar story. They're looking for that digital transformation. Their attempts to reintroduce a dividend 3 months ago was really nothing more than a toe in the water. But again, it seems that most of the banks are currently saying we'll give you more of an update at the half-year numbers towards the end of July. Again, if we compare it to the RBS of old that you mentioned, what was starting to become something of a sprawling kind of behemoth, especially with that ill-fated takeover of ABN AMRO, RBS stroke NatWest very much sticking to its knitting. So it's not far behind Lloyds actually as being another barometer of the UK economy. So many of the things now that it has started to tighten up its balance sheet, again the capital cushion is very strong, the return on tangible equity is improving quite strongly. So not a dissimilar story to what we've been seeing with Lloyds, perhaps unsurprisingly.
Becoming a bit more like a Lloyds and a bit less like a Barclays or an HSBC.
Right.
Yeah. And Barclays itself always seems to me over recent years to be the bank that's having a little bit of an identity crisis. It doesn't quite know what it wants to be, which direction it wants to shoot off in. We've got the investment banking arm of Barclays, then we've got the retail banking arm of Barclays. How is Barclays doing and what does its future look like?
Well, strangely enough, that's one of the things that's been in its favour over the last year. What they've described themselves as having this universal banking model, and you're absolutely right, there's any sort of mixture between retail and institutional, UK and US. Historically, they've got that very strong investment bank, which has not only been doing well during the course of the market volatility, but there's also a number of deals, IPOs, etc., which have been going on in the background, which has been to Barclays' benefit. The UK retail side hasn't been performing quite so strongly. And in some ways, a lot of people had thought that Barclays, because they were the last to report, would round off the reporting season in some style. But there was an element of disappointment there, not least of which, because as we've mentioned, the other banks had been releasing some of those provisions, whereas Barclays chose to take a much smaller impairment charge of about 55 million, bitterly compared to 2.1 billion the year before, but nonetheless it was a bit of a jolt to the system compared to what the other banks have been doing. So the main thing that works in Barclays' favour, as we've been seeing over the last year, is that simple diversification, both in terms of business line and geography, which can come into its own when the going gets tough.
So it's got the scenario where it's dependent on the UK economy for its UK retail banking arm. If that picks up, I mean, again, it's the credit card stuff is really hampering it. But it's also got that investment banking arm, and if the stock market does continue to do well, and we see a pickup in IPOs and deals, mergers and stuff like that, that's where Barclays is going to pick up the big bucks, isn't it?
Yeah, you're absolutely right. And of course, at the same time, the beauty of a diversified business model is the ability for one part of the business to pick some of the slack up in those tougher times. So all things being equal, it should be a natural hedge.
Mm-hmm. And finally, onto the bank that I don't think anybody could accuse of not being diversified, the global mega bank that is HSBC. That's very much a big picture set of results whenever you read HSBC results, and also one of the most insanely complicated sets of results to ever work your way through, isn't it? What are HSBC saying? How are they doing?
Yep. Again, famously robust balance sheet, so no problems with the capital cushion, no problems with the so-called liquidity coverage ratio and the pool of liquidity which it could tap if it needed to. Obviously, in terms of its history, Hong Kong and Shanghai Bank, it's got a large exposure to the Asian region. The jury's still out on, as to whether, with China effectively being first in, whether they'll be first out of the crisis in terms of economic recovery. There's also some geopolitical tensions in the area. So the Asian region for HSBC isn't quite the slam dunk that it should be, but you can clearly see what the prospect could be over the next 5-10 years, particularly if, as predicted by many, China becomes the largest economy in the world. That being said, it is an absolute giant, as you say. It's got any number of regions that it's in, although perhaps it's a bit more traditional in terms of its corporate and retail kind of broking and lending, as opposed to the likes of Barclays, for example. Funnily enough, it's been, in comparing the UK banks as a whole, it's tended to be the one that's been out of favour for the last year or so. Some of that's geopolitical tensions in the region, but also it's the sheer size of a bank, which again says it's looking to transform itself, but it's the old story of the super tanker, which can't be turned around very quickly.
And just finally, before we finish, if I think back to the pre-financial crisis days, the sort of tail end of that early 2000s boom, my early days of financial journalism, people loved bank shares. Investors absolutely loved banks, didn't they? Obviously, you know, the hangover of the financial crisis has been that not a lot of people love banks anymore. Do you think investors will ever fall back in love with bank shares? Or do you think it's done, and it will be a new set of, you know, financial institutions that come along and investors get really keen on?
I think that's a really interesting question, because one of the things we saw going into the pandemic last year is that the banks, rightly or wrongly, probably a little bit towards rightly, had been vilified as the cause of the great financial crisis in 2008, and they very much wanted to be seen leading up to the pandemic as being the saviours this time around, in terms of the billions of pounds they've been lending to individuals, to businesses, payment holidays, overdraft holidays, etc., really doing our bit for the community. And to be fair to them, there has been a lot of that lending going on, and again, not necessarily money that the banks are going to make a great deal of money from themselves. But one of the reasons investors had previously been in love with the banking sector was the scope of the dividends, which were rather like the oil majors. They were just going to carry on forever, Lloyds in particular, sort of thing. But the question now, I think, for banks generally, and this applies in the States as well, is whether they're going down the route of simply becoming utilities, low margin, high volume businesses, or whether they can do something a bit more imaginative, such as fee income, for example, let alone any expansion that might come along. And clearly one of the real exciting prospects from a banking perspective, if not from an individual perspective, could be that if we just see a few branches dotted around the country and the rest of the services are provided digitally, there's going to be immense savings, which obviously can then again be reasons for deploying that capital. So it's going to be a very interesting time, but they have certainly, to some extent, the hangover of the financial crisis from over a decade ago is still following the banks around.
I suppose if people start making money from them again, they'll probably fall back in love with the banks, won't they? Yeah, investors are simple creatures sometimes.
Absolutely.
Yeah. Oh, that's all we've got time for. Thank you very much.
Pleasure.
And thank you very much for joining us on The Investing Show. See you next time. Goodbye.